Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again Michael Oliver, who joins me almost every week whenever it's possible. Anyway, I'd like to have Michael on. He is the author of Momentum Structural Analysis, a very wonderful report that you should go to learn more about MSA, OliverMSA.com. And learn more about Michael's work. He does make it available now to accredited investors. It used to be available only to a very select few major financial institutions, but now Michael is making it a bit more broadly available, and we're grateful that he has joined us again today. Thanks for joining me, Michael.
Good to be here.
You know, I like to talk to you, one of the reasons, there's many reasons I like to talk to you. First of all, I think I have a building confidence in your work in terms of helping me perceive probabilities of what might take place in various markets, the key markets that I look at and the ones you talk about here frequently. But I also like to talk to you because, in a way, you give me hope that the evildoers in government, namely the Keynesians who are really trying to destroy markets, and hence, I believe, the lives and liberties that our founding fathers willed for us in the Constitution, you see you provide some hope that ultimately the laws of nature's markets will prevail. And of course, you wrote a little bit about this in your weekend missive. Would you care to comment on that thought?
Yeah, it's the struggle is most people that I encounter on one side or the other of that argument. They believe that government is in effect God and makes money. If you didn't have them, you wouldn't have money, and you wouldn't have roads, and you wouldn't have air, and it's a God. Okay.
Yeah.
And then there's people on the other side over the last 40 or so years who've evolved toward a more libertarian view of reality in the world, and that's an intellectual conflict. Okay, but it exhibits itself in the markets as well because the state, via its central banks, not just the U.S., but other countries as well, particularly the Western, quote, capitalist countries are the main examples of this, intervene in their markets to manipulate them as if the markets don't have an independent life, and if they did, it would be total chaos. We all know that, and so these wise men come from above. They never had a real job in their life, and yet they're going to tell us what the cost of money should be. Therefore, they set interest rates. They try to get us to allocate capital where they want us to allocate capital by discouraging us in certain areas or encouraging other areas. In other words, the planned command economy. And the markets naturally will exhibit the restraints put on them by these forces, or the encouragements by these forces, and respond accordingly, and probably respond in a way that they would not otherwise respond if they were free to trade. If the prices of commodity X were free to go whichever way it wanted, or this bond market go whichever way it wanted. So we have distortions, and they show in the markets. The problem is, at what point do the distortions reach actionable levels where it's going to go the other way? And it invariably does. We've seen it throughout history. I know a lot of gold bulls are very frustrated. They've been watching gold oscillate either side of 1180 for 3 years now. Yep. And they think the market is controlled, and to some extent I can't argue against that governments do wish to exert downward pressure on gold. But there's a point at which it won't work. There's a point at which you underprice gold, and no matter what they want to do or say about it, or even secret interventions if those things do occur, won't have the impact it might have had at $1,900 gold. I remember back in the bull market in gold in the 70s, the IMF auctioned huge blocks of gold periodically, and there were alleged reasons for this, but the main reason was to intimidate the rising bull market in gold. And there was a point they finally gave up. They would initially they'd auction a large block of gold and sell it, and you might see a dent in the gold market. But there got to be a point in the middle of that bull trend where the market just ate it up, and they didn't get in the way anymore. They backed off, and so it's a lesson to be learned. So it's always an issue of what timing. Yeah,
for sure. And I guess they just realized if they kept doing that, pretty soon they wouldn't have any more gold to play with.
Right. And right now we're faced with a very interesting historical philosophical duel between ex-communist nations coming to gold and Western capitalist nations wanting to renounce it and get away from it. what a world, right?
Yeah, it seems paradoxical, but then on the other hand, when I see the philosophical leanings of some of the ruling elite, I realize that their belief system is very close to, not that far from Karl Marx to start with. So.
Right, it has evolved that way, or Mussolini in particular, the father of the variant of socialism we call fascism. Anyway, back to the markets. The tectonic plates that I see out there, in a weekend report I discussed the government debt markets, particularly the European debt markets, which have been specifically targeted by the ECB and their QE programs, which started up again in January. So these are instruments that are the instruments they're literally buying, and yet that marketplace was ambushed off the page 2 and 3 weeks ago. Mm-hmm. It was as if, so what? You're bidding for it, we're going right through you. And if you just take a look at those charts, whether it's a yield chart going up or a price chart going down, that was a dramatic move. It took their breath away. The ECB was panicked. They as much said so. Last week, their executive committee member spoke up and said they were going to beef up their bids this month and next month in terms of quantity. Obviously ambushed by the markets, which proves it can happen. So the same principle applies to the equity markets, which have been vastly overpriced in Japan, Europe, and the U.S. by central banks. That, too, can come to an end. And similarly with gold. Mm-hmm. So all these forces that the gold bulls feel intimidated by the state, and if they sell into the stock market, they feel intimidated because it just invariably goes and makes a new high. Well, put it in context. The S&P's low today, last I saw, was 2099. That is 6 full points above the high of last December, the high of last year. We're almost mid-year. Mm-hmm. And we're effectively trading at last year's high. So it really hasn't gone anywhere in a sustained way. It's just held up there. And so I would think a stock bull right now should be about as frustrated as a gold bull. Mm-hmm. It really isn't going anywhere.
Right.
I'm looking for those plates to shift. I'm looking for the stocks to crumble, and we're not far from certain numbers, and for gold to reassert itself on the upside.
Right, and what I would like to just mention to my listeners is that Michael provides some very, very good charts that help you to see key breaking points. And, you see the resistance, you'll see something, the markets hit this sort of structural line several times, and then finally when it breaks through one way or the other, you know that you're off, probably the probability of making money and betting in that direction is very good, right, Michael?
Right. Let's see. The momentum structures are what I look at. In other words, I don't look at the price chart so much as I detrend price and I create an oscillator. And the oscillator sometimes will jump off the page at you. You can look at it and see something that the price chart doesn't reveal. Quite often a very pregnant trend change situation, whether a topping pattern or a bottoming pattern. And both gold and the S&P right now are not far away from, several percentage points. In case the S&P actually 1 or 2 percentage points away from breaking downward. In the case of gold, several percentage points below levels that would convincingly turn it up. And so that's what I monitor for. I see these things ahead of time, and then I monitor for the point of breakage. And in which case it's a buy or it's a sell accordingly.
In Europe, of course, it was the Bund, the German Bund, that it's just a fantastic picture that you showed in your chart of how, it was about a month ago, I guess, you were signaling, your work was signaling that the Bund was in trouble. And lo and behold, it really did tank, as you say, much to, I'm sure, the grief of the central bankers. What do you see for the Bund now? Or do you think we'll see a leveling off for a while?
The 10-year notes in Europe and the U.S. in particular, if you're short those markets, I think they're going to go up in yield and therefore down in price. Yeah. But I think they could be savage in that process, meaning you get very sharp rallies that I regard now as counter-trend rallies in the price of those instruments. We're getting one today. Well, of course, we're also getting a very sharp stock market sell-off, and there's your reason. Yes, I think rates are now headed back up. That trend is now over, largely a government-controlled trend over the last year, particularly in Europe with the various euro bonds. But because of the continued willingness of investors to move money into those instruments simply on the issue of safety, that's a dangerous thing if you short those markets, because you can get a rally exceptionally sharp, exceptionally quick that could hurt. Even if the rally does not make a new high, it can still hurt. And I think that's what's going on today, for example.
Yeah, so, and I would certainly
I use it as a barometer of a major asset category that's lost its control it's no longer under the control of the central banks. When I see that happen in equities, that will add more evidence to that overall process. And when I see gold turn up through 1255, that will be effectively the last piece of the puzzle.
All right, 1255 is the key. I know you've been talking about that.
Yes, remains that number. S&P now, interesting. We only have 3 days left in the month to trade. It's 20-some-odd trading hours. You get into the month of June, and not far below today's low. I get numbers, actually some start this week at 2087. You don't want to see it. Daily close there. Low today so far was 2099, the last I saw. So we're 0.5% away from the top end of a minefield. Now, starting next week, again in June, my numbers that indicate breakage, severe breakage, start at around 2090, get down to about 2070, and that's it. You get below there, and there's nothing left. It should be pretty much a sharp drop from that point, in which case then I think you can start to look back at the high of the year, which was several weeks ago, in the target zone that MSA had suggested early this year as the high of the year, namely 2126 to 2130 zone. And our closes all last week were right in that zone, each daily close. So that might have been the high, but I don't have enough evidence of that yet. If we break down another % or two, at that point my confidence level is pretty high that was the high of the year.
Okay. What today? Getting back to gold, today gold is taking quite a hit. It's down, I don't know, $15-20 or something like that. Does that change your view on anything?
No. I think my general view on gold is this: you're probably looking at the bottom over the last several years. It's been an oscillating base building process. We trade either side of 1180 was the low in 2013, late 2013. We pierced it last November, got down to 1130 and change, and immediately popped back above it, and we've gone quiet. So it's much like the stock market. I mean, it's really not going down any more than stocks are really going up. They're not. It's a congestion process. I think it's topping for stocks, bottoming for gold. Now, what if the possibility of gold make one more new low? It might. I don't put a very good bet on that. If it did, I think it would be a rocket ship V-bottom situation. And my bet right now is no, you're not going to make a new low, that November low was probably it. Now, as far as investment commitment to gold, aside from someone who wants to have X% always in gold, is missing that part of the debate. If I were trading gold every several years, let's say, buying it low and selling high type thing, 1190, definitely 80, so forth, several years ago was a sell. We argued that case. Now I argue the opposite. I think you should be at least 25-30% long gold, whatever amount you want to have in it, dollar amount. And we get above get up to the 1255 level, I would go 100% at that point.
Wow.
Whatever amount of commitment you want to have in gold. But right now I'd only be 25-30% long and relax. Don't get too heavy too quick. Don't be afraid to pay up a little bit for it, because if you pay up at the right point, then you have the inertia at your back, the wind at your back. And right now I think the wind is sort of going sideways.
Right. Now let me just clarify, I think what you said, you would suggest 25-30% of the amount you want to allocate to gold at the peak. In other words, it's not 25 or 30% of your entire...
Whatever amount you want to commit to a new gold bull market, and you have the resources sitting there ready to commit, don't commit it all. Commit that portion.
Sure.
Now, with more positive evidence, then go ahead and commit the rest. And I'm arguing that next level is 1255. That number will get lower next quarter, but for the remaining 4.5 weeks of this quarter, that's still the number.
You had some interesting things to say here with just a couple of minutes left in our segment here. You had some interesting things to say this weekend on commodities and gold. You like to look at spreads. One of the spreads you looked at was you looked at the shares, I think, relative to S&P 500. Perhaps you could comment on that. Your view is that the shares should lead the bullion this time, I believe.
Now, I think they will outperform. Whether they lead in terms of breaking out, I'm not sure, but I think that from here on forward, if gold goes up, you don't want to be long gold so much as you want to be long GDX or gold miners, and some folks are good at picking those on a fundamental basis. And I'm looking at an aggregate called the GDX, the ETF, the major gold miners. And right now, if you divide the price of the GDX into the S&P, you'll get something like 0.9%. It's 0.92, I think, actually. If you ever see a weekly close where when you divide the weekly closing price of GDX into the weekly closing price of the S&P, and it comes out to be 1.1%, that spread has shifted. It says at that point going forward, gold miners are going to beat the S&P on a relative performance basis. I also argue they're going to beat gold on a relative performance basis. Mm-hmm. So I look at these relative performance shifts because quite often they're also coincidental with net price trend changes. So if GDX shifts positive to the S&P on a spread or relative performance basis, you can bet pretty well that the GDX is also turning up on a net basis.
All right. Well, just one more quick question here to do with CRB and gold. You also provide some spread analyses there. What are your thoughts there? Your belief is that gold will lead the commodity index, the commodity sector, I believe, right?
It has, and it did that in the mid and late 70s. Gold made its corrective low at $103.50 in August of 1976. Now, that was a big drop because it started out when they legalized it in January of 75 at $200. He dropped from 200 back to 103. That was summer of 76. Commodities as a basket did not bottom until summer of 77. And in that intervening year, gold not only made its low, but started up, and its spread, when you measure gold against the basket, and I used CRB index back then, clearly turned up, and it was the spread itself was just roaring. Gold was handily beating commodities. Well, so what? Well, what ultimately happened is with that lag of about a year, then the net price trend of the CRB also turned up, and as you know, we had a major bull market, not just in gold, but in a basket of commodities throughout, up till 1980. Gold led the way all the way to the top. And in fact, its spread topped before commodities topped. About 9 or 10 months before. Well, we've got the same thing now. Gold has turned up very strongly against the Bloomberg Commodity Index, which is the one I use now, which is very similar to the old CRB in its makeup. It says gold has now assumed leadership. It did that late last year. So, okay, now we're about 3/4 of a year after that event, and I'd be looking for a commodity bottom.
All right.
And I think what we'll see is a gold bull leading commodities, beating them, but commodities following along as a basket.
All right, very good. Well, interesting enough, and thank you again for being with us. Michael, we'll look to do it again hopefully next week. Thank you so much for sharing your time and insights with us.
Thank you. Bye-bye.